Hello and welcome to Switzer Super TV. So today I want to talk to you about something I know is on a lot of investors' minds, and that's the sharp drop in the oil price. The magnitude of the fall was really brought home to me by this chart. You can see it on the screen now. It's rare that you see a chart like this with no recovery. Nobody predicted that, not even us. The main reason behind the fall is an increase in supply. Just as the oil price chart over 12 months shows a big slump down, this one, which is US oil production, shows a big increase in the opposite direction. The previous oil poor US has recently discovered a wealth of shale oil, which is relatively cheap to produce. This has taken US production back to levels of the 1980s. The oil producing countries in the Middle East in particular, represented by OPEC, haven't cut production either, which means the glut in supply is pushing prices down. At the same time, we're seeing a fall off in demand with slowing in growth in some of the emerging countries. Okay, so you might be wondering, how low can it go? It's a good question. The historic chart on screen right now, which goes back to the 1970s and the big oil shocks of that decade, shows just how fickle oil can be. I'm optimistic that it will eventually settle at a rate closer to $60 a barrel, regardless of where the actual oil price is going to end up. Unfortunately, we may not have seen the end of the falls in the share prices of oil companies themselves. Let's look at the big three that are really most effective. You've got Oil Search, Woodside, and of course Santos. Of those three, I would say that Woodside is in the best position. It's a decent dividend player and payer, and probably got the wherewithal to withstand some of what's going on. It's in a better position to be able to cut costs, which is what it will need to do to find the margins its shareholders are used to, particularly when it comes to dividends. I'd even be considering adding it at the right price if we see further falls, but I wouldn't be adding Oil Search and Santos in the current environment. They're not going to actually disappear just yet, so you might just have to hang on for the ride if you already have them in your portfolio. As for Woodside, if you think it's going to go lower, adopt the dollar cost averaging strategy and pick up small parcels at a time over the next few months. That's what I'm going to be doing. As an investor, you can't forget the bigger picture. A lower oil price means lower petrol costs, which means more in the consumer's pockets, which will eventually filter through to greater growth. And the share market should come back as well. As a reminder, after the last three big oil price falls in 1986, 1998 and 2008, the US market rose by an average 23% over the following 12 months. Thanks for joining us on Switzer Super TV. I'm Peter Switzer.